Hi, my name is Paul, and in this video, I'm going to be covering MTY Food Group's third quarter financial results and conference call. And then I'm going to briefly go over how I'm valuing the stock and whether or not the recent sell-off was actually warranted. But first, I'm going to go through my expectations of what I'm hoping will be covered in either the report or the conference call. And all of this actually comes from my notes, which were written beforehand in order to help me keep track of the key points that I believe are crucial to my investment hypothesis. Now, really quickly before I get into my expectations, for anyone who might have clicked on the video not knowing anything about MTY Food Group, MTY is a company that owns over 80 different fast food and casual dining restaurant brands, which are both franchised and operated mostly in the US and Canada, though the company does have a growing international presence. MTY also distributes and sells grocery and retail products centered around its more popular restaurant banners. Currently, the company's shares are publicly traded on the Toronto Stock Exchange under the ticker symbol MTY. So, about a week ago, MTY completed its acquisition of Barbecue Holdings Group for about 257 million Canadian dollars. Unfortunately, because the deal closed in September and the third quarter release is only supposed to include information up until August 31st, we probably won't get to see the full impact of the deal on MTY's pre-existing business, or the balance sheet. That said, I am still expecting to get some new information about the acquisition with regards to how the deal is being financed. Also, I expect to learn more about what the management strategy is going forwards with Barbecue Holdings. When MTY originally announced the acquisition, I thought that the deal looked very pricey when considering the free cash flows that were being generated. But Barbecue Holdings has a lot of corporately operated stores that have the potential to be franchised out in order to generate significantly more free cash flow. So, because the value of the acquisition is so heavily dependent on the management strategy going forwards, having them provide an outline for their plans is something that I'm really looking forward to. As for MTY's operations, I'm expecting continued revenue growth in the newer retail product segment of the business. I also expect to see restaurant sales picking up because of the slowing COVID-related regulations, especially in Canada. In addition to that, I'm looking forward to getting an update on how supply chain related issues are being dealt with, or if they started turning around and getting better on their own. Though inflation probably hasn't helped much, and I'd suspect that profitability will be somewhat negatively affected because of this. Now, because of the comments made by the CEO on last quarter's conference call, I am expecting there to be continued issues with location closures, which isn't expected to shift into net openings until Q1 of next year. And that is of course assuming that there aren't any new surprises. Finally, I can't say that I'm expecting too much in terms of capital allocation, since there were probably already some behind the scenes acquisition plans taking place within the quarter in preparation for the purchase of Barbecue Holdings. So I think it's very unlikely that we end up seeing a significant number of shares repurchased or debt repaid. That should provide a pretty good framework for what I'm looking for in this quarter's report. So with that, we can get into it. Now, I personally prefer the Management Discussion and Analysis report because it contains additional clarifying notes and other important information that is generally helpful in understanding the cause of comparable quarterly changes. Also, I tend to skip past the key highlight page since I'm interested in not only the results, but more importantly, the factors contributing to those results. And all of the highlights will be detailed further on in the report alongside the essential explanatory information. So, starting with the revenues, the company saw growth of 14% when compared to Q3 of last year. And looking at the geographical segment breakdown, the Canadian operations pulled these numbers upwards, while the US and international side of the business appears to have had a slight decline. Looking specifically at the cause of the Canadian segment's outperformance, this was explained by two things. First was pandemic recovery, which involved people going back to work and led to more people eating out for meals, specifically bumping up franchise and corporate location revenues. The second cause was the food processing, distribution, and retail portion of the business, which saw growth of 41%. And most of this was organic growth of the retail products stemming from new listings and expansion into more stores. But there was also some inorganic growth in the increase coming from the acquisition of Couteau Comptoir, which made up $1.4 million in revenue increases. Just in case that last sentence might have been confusing, the reason that this is considered inorganic growth is because in the third quarter of 2021, Couteau Comptoir was not yet owned by MTY, so it wasn't producing revenues for MTY. MTY later bought out Couteau Comptoir, which is now earning MTY revenues. So, because we're comparing to last year's third quarter when MTY didn't own Couteau Comptoir, that $1.4 million in growth can mostly be attributed to Couteau Comptoir's existing business and shouldn't be attributed to future sales growth. So, that portion of the company's revenue growth should definitely be discounted. But the organic growth of the retail products still looks quite strong with plenty of opportunity for further expansion and growth. However, based on the website grocerycollection.com, which contains all of MTY's retail products, we can see that despite the increase in total products offered when comparing quarterly metrics, the website, which provides more up-to-date offerings, shows a decline of about 12 products from what was shown in the report. Now, I've hypothesized that this is because the management wants to cut products that are underperforming in order to maximize profitability. Noting that, this decline in product offerings is something that I've been aware of since September, so it isn't a huge surprise to me. But even in the conference call, the management has yet to comment on the reason behind this decline, though I'd imagine that next quarter they will give an explanation as to why this has been happening, since the decline in product offerings should become more noticeable on a quarterly basis. Nonetheless, this isn't super concerning since the retail side of the business is relatively new and the company did pump out tons of new products within only a couple of years, so naturally some of them won't be winners. But I'll definitely be looking for an actual explanation from the management next quarter. As for the US and international numbers, these were referred to as being mostly in line with the same period last year. Also, like in the last few quarters, there was a note regarding the corporate store revenues declining, which came from the sale of the corporately owned Papa Murphy's restaurants. So, kind of the reverse of what happened with Couteau Comptoir in that the Papa Murphy's restaurants were earning MTY revenue in 2021, but then they were sold, and in this quarter they aren't earning the corporate portion of the business any revenue any longer, because they've been sold. And that's everything for revenues, so now let's take a look at the operating expenses, which is the second part in determining profits. Unfortunately, this quarter operating expenses again grew faster than revenues in both Canada and the US and international segments, so we can pretty safely assume that this will mean that the profit margins are going to be worse than in Q3 of 2021. Now, Canada's expense growth appeared particularly extreme, but there were some mitigating factors that make things seem a little bit better than they actually appeared. Firstly, more than half of the increases in OPEX came from controllable expenses, which primarily make up higher wages due to the recent economic environment. And there was a really elegantly written outline of these issues that breaks things down in a much more succinct way than I possibly could have hoped to. So I'll read that out here. 2021 saw a shortage of qualified workers as well as an increase in labor costs due to competition and increased wages. These shortages in labor and increases in wages have persisted into 2022. Many individuals have left the restaurant industry altogether due to pandemic-related operating demands and, in some cases, the availability of government subsidies, and thus creating high employee turnover. These conditions have resulted in aggressive competition for talent, wage inflation, and pressure to improve benefits and workplace conditions to remain competitive and attract talent, affecting the company and its franchisees. That hopefully gives color to the economic challenges that the company is facing. Jumping back into Canada's expense growth, there were also some one-time transaction costs of $1.5 million pertaining to the acquisition of Barbecue Holdings Group, which also negatively impacted expenses. In addition to that, some of the Q3 2021 expenses appeared lower than they actually were, due to the COVID-related wage and rent subsidies that were being received at the time. In the most recent quarter, these temporary subsidies were no longer being received, so this overemphasized the growth of the expenses. Compared to Canada, international and US expenses seemed much more reasonable, though there were similar wage increases stemming from inflation and job vacancies. Also noted as a major contributor to the expense growth was office expenses, which was explained as higher annual licensing, cybersecurity costs, and travel and meal expenses. And there really wasn't a detailed explanation for these items. To summarize all of that, there were a couple of things that made this quarter's expenses look worse than they actually were. But even if we set those aside, expenses still did increase, which wasn't really unexpected, but it's not something that I wanted to see. Noting that, this did of course impact profitability, which I'll be measuring using unlevered free cash flow per share, since free cash flow tends to be a better metric for judging reliable profitability of a business. This is because net income, or earnings per share, includes non-operational income, which is exactly what it sounds like. It's reported profit that the company has earned, but that didn't have to do with the company's usual business operations. This can include things like the sale of part of the company's business or the unrealized change in the value of its financial assets, like if a company holds stocks and those stocks change in price but aren't necessarily sold. Now, neither of these inclusions would help you to understand how much profit MTY's restaurants and retail products are producing, but both of these are included in the net income or earnings per share. Free cash flow, on the other hand, specifically does not include non-operating income, so it gives a more precise depiction of the profitability of the business's usual operations. Anyway, compared to the third quarter of 2021, free cash flows have declined by about 40 cents per share. Again, this isn't what I wanted to see, but declines were expected considering the continued labor issues and inflation. Looking forwards, on the call it was explained that free cash flow is expected to continue to be affected by interest rate hikes for the foreseeable future, especially since the more value-centric brands are struggling to keep prices low. It was, however, stated that free cash flow should still remain strong, which I took to mean that future quarter declines should be relatively minimal. Moving on to MTY's liquidity, at the end of the quarter it looks like the company did not repurchase any shares. And it's in this section that we also learned that the company had about $55 million in cash on hand and about $300 million of debt available for use in their revolver. That said, there are further details shown later on in the report, which I will cover shortly. But before that, I want to first go over the total restaurant locations. This quarter, MTY once again saw net closures of 54 locations. And on the conference call, CEO Eric Lefebvre gave some additional context to this figure, mentioning that a total of 150 restaurant locations were impacted to varying degrees by the recent hurricanes that have been devastating the east coast of the US and Canada. Lefebvre also pointed out that many of the closures were due to franchisees choosing not to renew their contracts, which I would assume had to do with some of the recent economic struggles, making franchise operations more challenging and less lucrative. On the conference call, we also got an update on the new store construction projects, which had been experiencing delays over the past few quarters. And what was said was that supply chain issues are continuing to affect progress. So I'm expecting that these delays will probably continue into the next quarter, and hopefully they'll get resolved by the end of Q1 of next year. Also, something that I just realized is that MTY does disclose how many corporate stores it has. And in total, between the US and Canada, there are only 89 corporately owned restaurants. And this is actually substantially less than Barbecue Holdings' 116 total corporate restaurants. It really puts things into perspective to see just how much more franchise-heavy MTY is in comparison to Barbecue Holdings. Now, this graph here should give you a better idea of the geographic makeup of the current restaurant sales. And I'm only including this now because I think it'll be interesting to look back on to see how things have changed once the acquisition with Barbecue Holdings is complete. That said, because the acquisition closed partway through the recording period of Q4, we probably aren't going to have an accurate full quarter sales breakdown for the company until Q1 of 2023. Anyways, now we start getting into some of the most interesting parts of the report. In the subsequent events section, we actually got additional news regarding how the acquisition of Barbecue Holdings was completed. All things said and done, it cost MTY $284 million, with about $277 million of that coming by way of debt financing. Now, from earlier on in the report, we already know that there was plenty more than $10 million in cash on the balance sheet subsequent to the quarter's end. So from this, we could probably pretty safely assume that MTY has some other plans for that cash. Whether that be preparation for the upcoming dividend or just paying off other loans with higher interest rates, I can't really be sure. But we did get some hints in the conference call that I'll be covering in the next section of the report, the near-term outlook. It's here that we get some insight into what the management sees going forwards as they face supply chain challenges including inflation, disruptions and supply shortages, as well as rising interest rates and increased construction costs. To paraphrase, the management wrote that despite these obstacles, some aspects of the business are returning to normal, but that there's uncertainty as to when things stabilize. In the meantime, labor shortages and wage increases are expected to continue to increase labor costs, as well as lower operating hours in some restaurants. In spite of this, sales are for the most part back to pre-pandemic levels or better in many of the company's restaurants, and trends are encouraging. Also, the management believes that MTY's network is positioned well to thrive into the future, specifically stating even if a recession were to happen. Currently, the management is focused on assisting franchisees in generating sales growth, as well as opening new locations of existing concepts and achieving profitability objectives. The management team is also focused on the integration of the recently acquired brands, and management is still working towards maximizing shareholder value while remaining committed to seeking out potential acquisitions in order to increase the company's market share. Now, all of that was nice to hear, but a lot of it was fairly broad and general. Thankfully, though, we did get a better telling of the specifics in the conference call. With regards to assisting franchisees, it was stated that the company is planning to refresh and rejuvenate some of its pre-existing brands, though none of these brands in particular were mentioned by name. As for the integration of acquired brands, here is where we got the most context. Thanks to one analyst who specifically asked if MTY was planning to franchise out Barbecue Holdings corporate locations, we learned that MTY was not in fact planning to do so. To my surprise, Eric Lefebvre stated that Barbecue Holdings corporate stores are very profitable, and that franchising them out is not a priority. That said, MTY does have plans to take advantage of the unexplored development opportunities on at least 3 of the existing Barbecue Holdings brands, which involves the company creating smaller franchisable versions of Famous Dave's, Village Inn, and Barrio Queen, all of which were mentioned by name after noting that the company was already in franchising mode with the acquisition. Now, they did expressly say on the call that they're looking to expand the acquired banners within the United States, but personally, I wouldn't be overly surprised if some of these concepts started opening up north of the border, since currently there's only one Famous Dave's in Canada, and based on the ratings it's received on Google, the location appears to be quite popular. That said, while MTY's CEO did have some nice words to say about the existing Barbecue Holdings corporate team, there were additional comments made that led me to believe that the decision to keep the Barbecue Holdings corporate locations may not be set in stone, with mentions of franchising out a few corporate locations here and there, as well as the comment that the acquisition will complement MTY's primary expertise in running franchise-operated restaurants. So it could be that the corporately operated stores are going to be going through more of a test period to see if they actually perform as well as their planned franchise counterparts. Finally, expanding on the line of maximizing shareholder value, it was stated that right now, the management is looking to both pay down debt and aggressively seek out additional acquisitions, since according to the CEO, there looks to be a lot of good future acquisition prospects. Furthermore, during the Q&A session, there was a question that asked why the management chose to acquire Barbecue Holdings over repurchasing shares. And the CEO seemed pretty confident that the Barbecue Holdings purchase would provide a better long-term value than repurchasing shares, although he also noted that the company's share price should be much higher. Now, I'm not as certain about the acquisition as he is, but considering I'm a newer shareholder to the company, I'm almost positive that I don't have the same ability to recognize the true value of Barbecue Holdings brands beyond fairly standard methods of valuation. That said, given how strong the acquisition history has been for the company, especially when it comes to making very large acquisitions, and now on top of that having listened to MTY's plan for Barbecue Holdings going forwards, I definitely think that the Barbecue Holdings deal was at least somewhat cheaper than the face value price to free cash flow of about 22.85. That said, the numbers put up in this quarter's report weren't amazing, and there are economic headwinds going forward. The question is, did the stock deserve to sell off so significantly? The answer to that question is probably going to depend on your outlook as an investor. If you're a short to medium term investor, then there are a lot of performance related concerns that are going to be impacted by the poor expected economic conditions over the next few quarters. And the quarterly free cash flow decline this quarter was substantial, even when accounting for the artificially lower expenses in Q3 of 2021 and the immediately accretive free cash flow that will be coming in from Barbecue Holdings in the next quarter. On top of that, MTY is expected to be running with significantly higher levels of debt next quarter. As an investor with a long-term mindset, however, I personally see a company with an acquisition-adjusted trailing 12-month free cash flow yield of over 10% on a company that's still on pace to outperform fiscal 2021's free cash flow numbers. And that's in spite of the rising rates of inflation, continued labor shortages, and the loss of franchise locations due to non-renewals. I also see a company that is incredibly quick to pay down debt, even when the world was struck by a pandemic. Because of this, MTY's business stands out to me as incredibly resilient during the current unfriendly economic environment, And I agreed with the management when they said that the company is poised to thrive once conditions return to normal. Unfortunately, I have no idea when that's going to happen, and I'm not going to try and project it either. But when it does happen, I'm pretty confident that the company will be profiting larger sums of money and trading at higher multiples than it is today. So I'm pretty happy buying the shares at these prices, even if things drop another 30 or 40% from here. And for the purpose of transparency, I have in fact been putting my money where my mouth is, recently buying up even more shares of MTY in my Canadian cash account, and in my $100 per month Canadian Wealthsimple stock portfolio, which you can watch me invest in every month on this channel. That said, I am not a financial advisor, and this video is not financial advice. I made this video for educational purposes and to highlight my own opinions. This video should only be relied upon for inspiration to do further research into the company outlined. After all, I'm just a Canadian who likes investing and sharing what I've learned with others. And I hope you found something of value in this video. And if you have, please consider sharing it with others. Thanks for watching all the way to the end, and enjoy the rest of your day.